days. So.
Well, let's take a step back and look at the broader economy now, which of course is related to the inflationary environment we were speaking about. Our next guest is Jay Hatfield. He's the founder and CEO of Infrastructure Capital Advisors. It's an investment firm that specializes in energy, in infrastructure and real estate. Thanks so much for being here, Jay. It's great to have you on the show. Latest CPI numbers, we talked about them a lot last week. It really cemented fears of high inflation. What are you making of the numbers, and how does that impact investment decisions right now? What does our audience, retail investors, what do they need to be thinking about?
Well, first of all, thanks, Tim and Katie, for having me on. Well, it's a pretty unusual time, to say the least, in that we think we have a really horrific inflation problem. Mm-hmm. Worse, we think there's a misunderstanding. We really think it's as bad as the 70s.
Wow.
We're at, if you correct, most people have forgotten that in the 70s we measured inflation directly. So housing price increases went directly into CPI. So if you restate today's CPI on the 70s basis, we'd be at 12.7 versus the high during the 70s was 13.2. So terrible backdrop driven by housing, which is what the Fed really acts on. That's the primary transmission mechanism of monetary policy. But what's strange about this environment is you would think that would be a great bear thesis to sell stocks and short treasuries. But because of that very liquidity that's driving mortgage rates to all-time lows, it's also driving really all physical asset classes higher. So Bitcoin, treasuries even, which was counterintuitive in the stock market. So we think the market's more range-bound. There was a headline from Dudley that came out just as I was getting ready for the show, and the market went down 10 handles because I think he was predicting 4 to 5% short-term rates. I don't know if it was really quite that dramatic, but a bearish statement about inflation. So that's kind of the strange thing about this investment environment.
And Bill Dudley, of course, he is the former president of the New York Federal Reserve. He's gotten quite vocal in his time after retiring. But Jay, again, this is a show for retail investors, and you said we're entering a sort of range-bound environment. I mean, for the average individual investors who might not really be that familiar with the Treasury market, for example, where within the stock market, I mean, would they be best suited to shelter in, as if inflation really is as bad as the 1970s?
Well, the other fact that a lot of people don't focus on is there is 52 trillion of global pension assets. So we don't think that interest rates are going to go skyrocket. We think that they're going to stabilize in the 2 to 2.5 range next year. So we think it's fine to be more conservative now, to go into defensive dividend stocks, preferred stocks, which are senior to common, and also be cautious about speculating on potentially overvalued tech stocks, because that can be very rewarding during times of excess liquidity. But the Fed has already said they're going to taper. We think they'll accelerate rate increases into the second quarter. So when you have a shrinking monetary base or less money, you have to be more cautious, more focused on valuation. It's nice to have a dividend yield and to be more defensive. So that's what we're recommending right now. We don't think the stock market's going to take a huge leg down, but I think it's going to be more challenging. You have to be more focused on valuation.
Well, if we think about where we are year to date in the S&P 500, we're higher by more than 24.5%. And if you're a young investor and you've only been paying attention the last few years, you haven't really lived through a high inflationary environment, Jay. So if this is indeed the 1970s all over again, what does our audience have to understand about what they're going to see when it comes to returns in the equity market?
Well, we think that there's one bullish development that people haven't focused on enough, and that is the fact that, at least right now, a big corporate tax increase, a rate increase that is off the table. And that could have been horrendous for the stock market, because you not only have lower earnings, but you also have lower growth, because growth is driven by return on invested capital after tax. So that is very, very bullish. And we don't view the market as being significantly overvalued. We look at the Dow multiple because it eliminates companies that are arguably overvalued or at least have long-term earnings prospects like Tesla. The Dow's only about 19 times. If we're right about interest rates being higher but not infinitely high, then 19 is probably even a low multiple. So we would see normal returns next year in the market, which to your point, maybe some new investors aren't familiar with, but you're more up 10% and more a situation where you need to focus on valuation and be more conservative and not just go into the momentum stocks.
All right, 10%, nothing to shake a stick at, but if you've been a meme stock trader, trading AMC and GameStop, then that certainly might be a number you balk at. Jay Hatfield, founder and CEO of Infrastructure Capital Advisors, thanks so much for taking the time.